Let's bring in Kevin Green, senior markets correspondent, right away to help set up the action today. All right, KG, let's talk about the shutdown because it puts some limitations, some continuation of limitations on economic data. So what would you say matters the most as it relates to the shutdown and that data?
Well, I think it does matter when it comes to the Fed and their policy moving forward. Obviously, Jerome Powell actually spoke about that last week. The lack of data could actually create a little bit of a fog when it comes to the trajectory of the market, and so they may have to actually slow their rate-cutting path until we actually get that data back. And so at the end of the day, I mean, the market really hasn't been really too concerned about the lack of data at this point. It's probably actually better for the bulls for not getting that data. We have also a lot of privatized data as well that we'll get this week, but I think overall the market really hasn't been too concerned. I think when you start seeing a lot more delays when it comes to the airports as well as the the SNAP benefits and food assistance programs, which sounds like it might be actually resuming here on Wednesday. That's what Scott Besson is kind of alluding to here. That could actually stave off maybe some of the economic impact that we will see from this shutdown, just given the fact that obviously a lot of these programs are starting to run out of money. And so I think the market for the most part is really not too concerned about it, but we would love to see that data come back into effect here. And we're probably going to be in the latter half of this shutdown here once you start seeing a lot of these programs and airports starting to back up, especially going into the holiday season.
Okay. And I wonder, does that mean ADP takes on even more importance? Because there was a time when critics would say ADP was not as, they just criticized how the data showed up from ADP versus the government payrolls report, and especially when there was a divergence. But now it seems like, okay, I guess you do matter. What's your thought on that?
Yeah, I would agree. I mean, ADP is going to take front and center when it comes to this week and the data they're going to drop on Wednesday. And at the end of the day, we did see ADP actually adjust their methodology from a couple of about a year ago, 2 years ago or so, because there was a massive divergence. If you're looking at the employees or basically the companies that they cover, they're a little bit more services oriented and not as much manufacturing job oriented. So that's where you did see a pretty decent disconnect in the data in the past over the last 2 years. But at the end of the day, if you're actually looking at the data set itself and you look at the trend lines for the most part actually match what's happening within the government data. And so we're going to be focusing on the trend. Obviously, we did see a negative print for that last reading here, and you're hoping that we actually do see a little bit of a bounce for this month, and that probably gives the Fed a little bit more confidence that the labor market is not cracking too significantly. Unfortunately, we are also getting a lot of layoff announcements. This is something that is actually normal going into the remainder of this year, and usually actually the financial companies starting in December will announce some pretty aggressive layoffs as well, and then usually a lot of these sectors and companies and industries will start to rehire back in March and April of next year. That's usually the trend. So ADP is definitely going to be a very big focus, and we'll see what this number actually comes out. I think you're also kind of looking at the inflationary prints as well, because there is still a little bit of a concern that inflation is going to remain sticky. I mean, it's not really popular, Diane, but inflation's been moving up ever since May. So it's going in the wrong direction, and I think the Fed also recognizes that. So the balance of risk is still a little bit murky, and we'll see this week if the ADP report actually tilts that balance of risk to the labor market rather than inflation.
Okay, yeah, a good point, especially to the point you made going back to what Fed Chair Jerome Powell said about the fog and operating within that. And, there may be some caution as a result. Let's talk a little bit about some deal news. Watching Kimberly-Clark and Kenvue off the back of this deal, as is typical with the acquirer, if you will. I mean, this is, for all intents and purposes, a merger. But Kimberly-Clark under pressure, down 13%. Kenvue, though, soaring right now. I guess if you could just kind of capture what is happening here with this deal.
Yeah, so it looks like Kimberly-Clark is going to acquire Kenvue for around $48.7 billion. Now, this is a cash and stock deal, so you are seeing Kenvue up around 19% in pre-market trading, but the takeout target price, if you kind of add everything up, is around $21.01. So it's still trading at a little bit of a discount. Maybe there's also, some regulatory hurdles or premium that's being, discounted in this market at this point in time here. But this is after we have seen Kenvue obviously slide fairly aggressively because of some of the accusations from the White House regarding Tylenol, and Kimberly-Clark looks at this deal and maybe says that they could, acquire a company fairly cheap when you're looking at their product portfolio and make some type of efficiencies here. Now, Kenvue is really obviously known for Tylenol, but they also have Neutrogena, Listerine, Listerine, Band-Aid, Benadryl under their portfolio as well. Kimberly-Clark, really known for Huggies, Kleenex, and Cottonelle brands here. So an interesting deal. Not surprising that we are continuing to see M&A. It's not the only M&A deal that we are going to see today. But this is once again one of those situations where Kenvue didn't really have that many options, and they probably were looking for a sell or even a spin-off of some of their businesses in order to retain some equity valuation within this market here, because they've had a lot of headwinds when it comes to the U.S. government and their view on the company.
Good point. All right, let's talk a little bit about where things stand right now. So we're at the beginning of a new trading month. History would be on the side of the bulls if we're talking about trends. But, I guess how would you encapsulate where we left things in October and where you see us headed this month, especially when you think about also the earnings picture?
Yeah, obviously we're still making higher highs, higher lows. From the earnings front, we are beating the street's expectations, both for top line growth as well as EPS growth as well. And you are starting to see analysts actually re-rate guidance, especially for Q1, calendar Q1 earnings higher, which is actually conducive for equities moving higher as well. And you're talking about that seasonality, basically November and December, two of the best months that we could actually have all year generally. And that also is in an environment where volumes are really low. So when you have very low volumes, very low liquidity, it's very easy to kind of move prices a little bit higher, especially if you have individuals as well as institutional investors that are chasing performance in order to meet their benchmarks for the year. So that's really providing a little bit of a backdrop for potentially higher highs moving forward here. I mean, October was actually a pretty decent month. I think the biggest risk that you have is any type of reversal in policy when it comes to the administration and tariffs. And it seems like right now they're trying to cut tariffs in some respects here and not increase them. And if that's going to be the case, I think that's going to be a tailwind. And then you also have the semiconductor trade, the AI trade, which continues to stay intact. The other thing that's going to be kind of a highlight for the remainder of this year is look at the debt offerings from these mega cap names. If we start seeing those increase a little bit more, then you might get some speculators in this market that say, okay, maybe they're tapped out on the equity front and now they have to raise debt. We've already seen that with Oracle. You are also seeing that with Google. They did announce an offering, a euro offering today as well to raise some capital for AI. And that's usually, I wouldn't say that's the end of the cycle, but that's when you're starting to see raising capital in the debt markets is kind of that last area of resort, if you will. So it's not going to mean that the market's going to crash tomorrow or anything of that nature, but now we are starting to see a lot of these companies really lever up and eat into potentially some of their free cash flow over the next couple of quarters.
And then, KG, let's get your targets on the S&P 500 to the upside and the downside as we kick off this new month.
Yeah, to the upside, you were looking at 6890. To the downside, 6800. Volatility is still at around a 17 handle, so looking at more than a 1% move in the S&P 500 right now. If you kind of look at it, you'd like to see volatility start off high and then crush throughout the week. That would be probably a little bit more conducive for the bulls. But you have to be mindful that volatility is continuing to kind of ramp up. So hedges are still relatively cheap if you're looking at the money calls or at the money puts right now.
Okay. All right. Great stuff there. That is Kevin Green, our senior markets correspondent. Thank you, KG.